There is a big problem I see repeated amongst business owners. That is that they're so focused on their business that they miss out on big wealth building opportunities outside of their business, and they put these opportunities in the back burner until it's too late. In this webinar, we will talk about how you can mitigate those risks and actually build wealth while you're also building your business and plan for a successful exit. We will discuss 6 steps that business owners need to take to build wealth. The first step is to get clarity on your finances. The second step is reduce taxes. The third step is to invest. Fourth is to protect assets. Fifth is to plan for an exit. And sixth is to decide on partnering with a financial advisor. So before I begin, let me introduce myself briefly, and then we'll start on these 6 planning ideas. My name is Roshni Pandey, and I'm a financial advisor and founder of TrueRoot Financial. TrueRoot Financial is an investment advisor and financial planner. We are 100% fiduciary, which means that we always keep our clients' interest first. In fact, we are legally and ethically required to do so. And number 2, we don't do any commission-based business at all. A lot of advisors out there sell mutual funds or insurance products and make a commission out of it. This introduces a lot of conflict of interest in their business. Whereas with us, we don't do any commission-based business at all in order to avoid these conflicts of interest. We don't have allegiance to anybody else, no mutual fund or no insurance company besides our clients. Our clients are the only people we get paid from. First step is get clarity on your finances is by doing 2 things. First is doing a balance sheet, and second is a statement of cash flows. A balance sheet is basically a listing of your assets, your liabilities. Assets minus liabilities gives you your net worth. And that's what we have here. This is the sample balance sheet. For this client, for example, they have $208,000 in the bank. They have about $760 invested. They have about $2.5 million in real estate. So that gives their total balance, total assets of $6.5 million. They also have some liabilities here, and assets minus liabilities, their net worth is about $5.6 million. Now, what's important in looking at a balance sheet is to know that as we age, our assets should be higher than our liabilities. So basically, our net worth should go up as we age and as we get closer to retirement. So that's a balance sheet. The second thing that we need to get clarity on our finances is to do our cash flows. So this is a cash flow for a sample client. This is basically a projection of their cash flows from 2022 until the end of a client's life, until they are 90 years old. So this client is a couple. The husband is 43 years old. The wife is 41 years old. In 2022, they had this much income, well, about $500,000 in income. And, this is all the income they had. They didn't have any other inflows, no rental income or anything. This was their income from their business. So that's the income. And then this is the projected expenses that they have in 2022. This includes all their personal expenses, like their groceries or mortgage, their travel, childcare, etc. And then we also have their taxes. We modeled out what their tax payments will be and inputted that as well. And the inflows minus the outflows gives us what they will have left. They have about $81,000 left after we take into account all their expenses and all their outflows from their income. So just looking at this, we can see that they're actually leaving a lot of money on the table. So this cash flow goes from now until 90 years old. Let's look at half of this just so it's easier for us to see. So if I look here, so from 2022, so they have an unaccounted for cash flow of $81,000. So this is how much money they have that they're not spending or saving that's unaccounted for. So this is a really important thing for them to realize, because there is additional money that they could be investing that they're currently not doing. So that's the first thing that jumped out to us when we looked at this cash flow. The other thing that was interesting was that they have a very very big tax payment. They're paying $115,000 in taxes every year. This includes their federal, state, payroll, everything, all of those taxes included. So this is, a pretty big number. So they're paying a lot in taxes. And, they're not planning to save that much. So they have a little bit of a saving, this year and next year, $66,000 in 2022, $81,000 in 2023, et cetera. But then the years after, it's only $22,000 each year, which is not a big amount given how much they're making. They're making $500,000, but only saving $22,000. So this is the cash flow analysis we do. So you do need to take into account that our expenses will increase, our income might also increase, or things might change as time passes, and input that into the cash flows as well, so we can make the correct projections. So we at Trueroot Financial use a financial planning software to make all these projections. So for example, in 2033, we have their kids going to school. So we have shown here that they have some planned distributions where they have kids going to school, and we have accounted for that. Similarly, once they reach the age of 72, they will be required to do distributions from their retirement accounts. So we show that as well over here, at that age. And all of this helps us understand, do they have enough money to live the life they want? Will there be a year where they will run out of money? From now until the end of their life, will they always have enough money or not? And if they don't, then what do we do about it? We need to plan for those circumstances. So some of the action items that came out of this cash flow planning was, number one, to do a 401k. So as you saw in the statement of cash flows for this client, they are paying a lot in taxes, number one. And number two, they also have excess cash left over every year. But instead of just saving it in a savings account, if they put it in a tax advantaged account like a 401k, they can save a lot more. So that was one action item we discussed, was starting a 401k, because not only do they save, they also reduce taxes. Number two, doing a strategic tax plan for them, because their business is so profitable. We also discussed doing a profit sharing plan that goes on top of the 401k plan. A profit sharing plan is basically a retirement savings plan that allows you to save even more in a tax advantaged way. A profit sharing plan has to be equitable to the employer and the employees as well. So you definitely need to get advice from an advisor to make sure that it's worth it for you. We also talked about doing a cash balance pension plan. A cash balance pension plan straddles between an investment account, a typical retirement account, and an insurance account. It has some components of both. So as a result of that, you're able to save a lot more. You can save hundreds of thousands of dollars and save it in a tax advantaged way. Extremely important to remember. It's not enough to just save. You have to save in a tax advantaged way, because taxes are constantly eating away at your profits. Something else we also discussed was investing the excess cash. And then this cash flow analysis also allows us to do business scenario analysis as well. Now, I mentioned before, we use a financial planning software to do the cash flow projection. If you sell your business today and then start something else with that money, how will that affect your total wealth? Those kind of scenario analysis as well we can do using the financial planning software, and that'll show us that cash flow. And then lastly, this is more of a personal financial planning, but because the person and the business are so intricately linked in this case, we also discussed doing a 529 college savings plan for the client, as they have 2 young children, and that would allow them to save in a tax advantaged way. To gauge if these action items are successful or not, we did a Monte Carlo analysis. A Monte Carlo analysis is a statistical analysis where the system does 1,000 trials to see, is there a year where this will not work? Of the 1,000 scenarios out there, and the scenarios could be anything like, what if there was a Great Depression again? What if there is a Great Recession again? How will that impact the portfolio? So in those 1,000 scenarios, there are some scenarios that have taken place and some that have not even taken place. And basically, this Monte Carlo analysis shows us what is the probability of success of this portfolio? Success meaning the client will never run out of money. What is the probability of that given the way we have allocated, the way we have planned? And if we were to just do what the client is doing right now, not do anything, the probability of success is 35%, meaning that 65% of the time, the client will run out of money in their lifetime. But if we do the changes we discussed, like doing the 401k, doing the profit sharing cash balance, investing excess cash, and the 529 plan, all of those, then the probability of success goes up to 90%. So the client will not run out of money up to 90% of the time, which is awesome. So that's the first step. The next step is to reduce taxes. We talked briefly about reducing taxes when we talked about 401k, profit sharing, cash balance plan, etc. A few other things that other business owners can also do besides that is if you're self-employed, you can also start a SEP IRA or a solo 401k. A solo 401k is a great choice because you can put away a lot more with a solo 401k than with just a SEP IRA. S Corp election, this can also help reduce your taxes a lot. If you're an LLC and your cash flows are very healthy, you're actually paying a lot in payroll taxes, and doing an S Corp election helps you reduce those taxes. Now, if you are a tech founder or a life science founder, something else that can be really effective in reducing your taxes, besides everything we talked about, like a 401k, is a qualified small business stock tax exclusion, QSBS for short. Now, QSBS is a rule where if you hold small business stocks for more than 5 years, you are exempt from up to $10 million in capital gain taxes when you sell those shares or when you exit the business. Now, the exemption itself is only $10 million, but if you do trust planning, you can actually multiply the exemption to however many trusts you make. Something else that's also available for tech founders is the 83B election. So every time you get a stock grant from your board, if you do an 83B election, you pay taxes based on the value of the stock at that time. And that way you don't pay taxes later on when the value of the stock increases at exit or at any other time. There is some time constraint for an 83B election, so you need to make sure that you speak with the tax advisor and get clarified on the timing and the actual steps you need to take to do this. Similarly, for the QSBS as well, you need to have documentation, spick and span. Everything needs to be very organized for you to claim this. And for a lot of businesses that take years and years to get to that exit point, a lot of these steps can be overlooked. So need to make sure that the documentation is all clear there as well. Step 3 is to invest. When you're investing, there are 3 things that are really important to do. The first is to develop an asset allocation. Now, what is asset allocation? Asset allocation is basically making the big decisions. So decisions like how much should you be in stock versus bonds? Within stocks, how much should you be in US stocks versus European stocks versus Asian stocks versus emerging markets? How much should you be in large stocks, large cap stocks versus small cap stocks versus value growth? All of these big decisions, research shows, dictates 80 to 90% of a portfolio's performance, and only the remaining 10 to 20% comes from the actual stock selection. If you invest in Google versus Amazon versus Facebook, Netflix, etc. So it's really important to pay attention to these big decisions, the big asset allocation decision. Now, how do you make the asset allocation decision? Asset allocation depends on 2 big things. One is time horizon, and the other is risk tolerance. Time horizon is how much long do you have to invest? If you have only a year to invest, if that money is for you to buy a house or for you to pay a debt or anything like that, you shouldn't even be in stocks because stocks are too volatile. You might lose most of that money in a year. So you should probably be in some kind of a treasury bond or some kind of a CD or just even stay in cash if you only have a year. However, if you have a longer time horizon, meaning you don't need the money for 10, 15, 20, 30 years, you should definitely invest in stocks. Number 2 is risk tolerance. Risk tolerance is basically your own risk appetite. How much risk are you comfortable taking? After that, diversify. Diversification is extremely, extremely important. It is something that is so widely known, and yet people ignore it because it's so tempting to just, concentrate on something, let it ride the market. But when things go bad, diversification is what really helps you. Now, how do you determine if something is diversified? Basically, the sources of risk and return, if they are different, that means your portfolio is diversified. Next is rebalance over time. So once you have an asset allocation, say I'm going to do 90% stock, 10% bond, and within the 90%, I'm going to do 70% US, 30% developing markets, etc. Make sure you stick to that percentage. So even when US stocks do well, make sure to sell some of it, put it in the lower performing stocks, and that way you always end up buying low and selling high. Step 4 for building wealth as a business owner, protect your assets. Now, when we talk about protecting assets or financial assets, we're basically referring to two things. One is insurance and the other is estate planning. When we talk about personal insurance, there are a few personal insurance that applies to almost everyone. If you have dependents, you definitely need life insurance. For most people, a term life insurance is sufficient. However, if you have significant net worth, you might also need to look at a whole life insurance. Similarly, if you're working, you need a disability insurance. And in fact, we are more likely to be disabled than to lose our life. So disability is extremely important. And disability doesn't always mean full disability. It can also mean partial disability. Excess liability insurance kicks in once the other insurance are exhausted. Long-term care, if you're over the age of 50, you should definitely look into long-term care because it gets more and more expensive and difficult to get as we get older. Buy-sell agreements. This applies if you have a business with other business partners. Estate planning can be very simple or complicated depending on your estate. Estate is what we leave behind once we pass away. This could be our home, our business, our possessions, et cetera, et cetera. So a foundational estate plan document includes a living trust, which includes a will, financial power of attorney, and healthcare power of attorney. After that is succession planning, planning for what happens to your business next. And this could be selling your business, a plan for selling your business, which we will talk about, or it could be passing your business to your children or somebody else, and that's all part of the succession plan. And this also includes the buy-sell agreements. If one of your business partners passes away, then you need to be able to make sure that there is a succession plan in place for his or her business interest to be transferred to the rest of the owners. If you have significant wealth or if you're a tech startup, you might also look into doing an irrevocable trust. And an irrevocable trust, as the name suggests, is a trust that once you make the trust and once you put assets in the trust, you cannot take it back. Step 5 is exit planning. When you think about exit planning, you have to start with an end in mind. Now, what does that mean? That means you have to know, what do you want to do with the proceeds of the sale? Are the proceeds of the sale going to be used to support your life and your retirement? Or are they going to be used to start a new business? Or are your children going to take over the business and they're going to pay you out? So in each case, you need to know how much you need to support the goal you have after the business exit. If a lot of the times business owners will say, I just want to get the best price, but you won't know what the best price is until you know what the minimum price is. So you need to know how much you need to walk away with in order to support the goal that you have in mind. And if you get more than that, that's great. But if you get less than that, that's no good. The second thing is you need to pick the right corporate structure. If the plan to exit is to sell to somebody, it's going to have a certain type of a structure. If it's to do an IPO or to go public, it has to have a different kind of a structure. If it is to bring new shareholders, lots of new shareholders, it's a different structure, et cetera, et cetera. The third thing is to increase value by planning correctly. And to increase value of the business, there are a few steps you can take. The first is improving cash flow. This is extremely important. To improve cash flow, you can do things like, instead of buying, you can lease You also try to have meetings with your bookkeeper where you go through all the expenses and get rid of any expense that is not needed, because that can really increase the value of your business and the multiple you might be able to get. Something else you can do is increase profitability, which could mean increasing revenue or cutting down costs. Diversify revenue streams and create recurring revenue. Recurring revenue is extremely powerful. It's much more attractive than one-time revenue. Streamline operations. So things like inventory, payroll, try to systematize it, try to bring technology to streamline these operations. Attract and retain talent. And to do this, you often need to have good benefits like retirement plans, cash balance plans, stock plans, all the things we talked about. That's good for the business owner. It's also often good for the employees. Enhance your pipeline. And lastly, perfect books. Your accounting, your taxes, your legal outsourcing, all of that needs to be done perfectly. Make sure that all of your personal and business expenses are kept far apart. They're not mixed together. You don't use your business card for your personal expenses and vice versa, because this will be very important when it's time for you to sell the business. And lastly, number 6, deciding to partner with a financial advisor. Now, there are different stages where business owners might be. Your financial advisor will help you in different ways. If you're in the early to mid stage, your financial advisor might help you grow your net worth and value of your business by helping you start a 401k, by helping you do a profit sharing plan or a cash balance pension plan, or doing an S Corp election. They will also help mitigate risks by helping you find the right insurance, by helping you do an estate plan, by helping you put together a succession plan, buy-sell agreements, etc. Now, if you're in the mid to late stage, your financial advisor will not just advise on the business issues, but they will also bring a lot of outside experts, outside help as needed. This could mean bringing a great business coach into the mix, or a great estate planner, or a great tax advisor to prepare for the sale. If there are multiple business owners in the company, or even lots of shareholders, there'll be lots of interests represented. Everybody will be trying to do the best they can for themselves. But who is in your corner to help make sure that you get the best value from the exit, that you are satisfied with the business that you've built and the exit that you'll be getting? And that is the financial advisor you bring in. This financial advisor will have a long-term lens that is solely focused on your financial goals and well-being. So those are the 6 steps you need to take in order to build wealth as a business owner. If you have any questions, please don't hesitate to email me at roshani@truerootfinancial.com. And also please check out our website, www.truerootfinancial.com. You can also book a 30-minute free consultation with me there.